and famine in Europe. I mean, it was a far more difficult time than the mythology that you see out of Hollywood. Carl Riccadonna knows this. He has studied our economic history. He does it with wonderful dynamics of aerospace engineering, and this morning none of that matters. What matters is the historical moment. Carl, I say beneath the headline data. What beneath the headline data matters to you this morning?
Well, good morning, first of all. I think what matters most beneath the surface, because we can cast a few categories out right off the bat. The unemployment rate will surge, but because of participation calculations, it's not going to show the full extent of the dislocation. Average hourly earnings will be totally distorted by lower wage workers being furloughed. So in the underlying details, what we need to focus on is two things. Number one, the contraction in the work week, and that often gets lost in the shuffle, but just a 1/10 decline in the work week is the equivalent of about 250,000 on a non-farm payroll. So work week is number one, but even more importantly, I think we need to focus on the composition of jobs. And so we certainly can see how bartenders and restaurant staff, hotel workers, how they're being impacted by the shutdown in the economy. What we need to do is isolate that number, the most vulnerable workers, the obvious categories, take that out and look at what is happening in the rest of the economy, the factory jobs, the high-skilled service jobs, and see what the extent of economic pain is on that front, because it will be harder to restart those parts of the economy.
Okay, so just extrapolating forward as to what that will mean. In other words, that if there is a substantial amount of job losses in those higher paid positions, that means that it's going to take a lot longer and that this recovery is going to be a lot more painful. Is that right?
That shows deeper consequences of the economic shutdown in the economy. We can easily understand if restaurants shut down, waiters and dishwashers get laid off. This speaks to much more significant problems in the economy. There's some notion out there among a lot of analysts, well, this is a man-made shutdown, so we slammed on the brakes, we can release the brakes, and things will get going again. But expectations for that type of V-shaped recovery have continually faded away from the landscape. And if you're looking at an unemployment rate that's going towards probably 20% or maybe even higher over the next couple of months, then it's going to be very difficult to get all of those workers back in jobs and also willing to spend on discretionary items like new cars and big-ticket purchases over the coming months.
You know, it's interesting. Neil Kashkari of the Minneapolis Fed saying that he thinks the real number is probably around 23 or 24% with respect to unemployment. Some people are saying, Carl, that this time is a little bit different in that workers who have been laid off have been receiving checks from the U.S. government, so we'll have more discretionary spending on the other side of this, which will help speed up the recovery. What do you say about that?
I don't think that's necessarily true. Of course, there was a little bit of a supplement added to unemployment insurance to help folks navigate the current quarter. But unless we see continued supplements to unemployment insurance, either extending the length of the period that unemployed individuals can collect, or further supplements, then this kind of operates in the normal circumstances for an economic shutdown. So by no means should we discount the importance of that economic stabilizer. And I think unemployment insurance may be one of the most. Of all these creative programs we put into place, unemployment insurance is a critical lifeline for most households. But I don't think we can say that that means consumers will be on significantly better footing because for most households, unemployment insurance doesn't fully replace the income lost. It's only a minor patch.
You're going to read that text, Carl? Keeps binging.
I'm going to absolutely read the text to see how BLS is grappling with these numbers that they have to make changes to seasonal.
Nice. Well done, Carl. Well done.
Carl Riccadonna, a Bloomberg Intelligence chief economist, joining us on the payrolls report around about 40 minutes away.
That's Lawrence Kudlow texting Carl Riccadonna to find out what to say to you later.
What, if trying to find out the questions?
Yeah.
Get an ahead look at it. Honestly, that was a fantastic pivot. You know, are you going to read those texts?
Yeah.
You mean that I'm working right now and I'm trying to work?
Carl's very sharp. He's very sharp indeed. Look, as for this interview a little bit later, guys, I mean, typically, and you've heard these interviews many times, They're well-spirited, good-spirited, a lot of energy, back and forth. This one's going to be different. The tone of this interview is going to be different. Just on a day like today, Tom, with a jobs report like the one we've got, and I know that so many people have become so familiar with this jobs number over the last couple of weeks because of what we've seen with claims. That's going to make little difference to the people that make up this number. This will be painful. This is history in the making, and I think that we need to have the appropriate tone around it when it comes out and when we discuss it as well.
There's no question about that, and what will be interesting with Lawrence Kudlow, and this goes back to his time at Bear Stearns, is he has a clear memory of the goods-producing collapse of 73, 74, the double recession of the early 1980s, and of course that's when Paul Volcker showed up to save the day. And I hope that Mr. Kudlow can put some historical perspective on this, John, that maybe we don't hear from others within the administration.
Yeah, and we've got to be realistic about how quickly we can recover. I know that's something we've all been thinking about, including you, Lisa. It's going to take a long, long time. We need to be realistic about that. When you turn the lights back on, naturally, some of these industries will pick up and rehire quite quickly. There will be other industries, other sectors of the economy which will take a whole lot longer. There will be other sectors that will actually have layoffs in the future as well as they reassess the demand backdrop in a new world.
I think one interesting question will be for Republicans that traditionally have been more concerned about debt. How much do they sort of double down on stimulus efforts and infrastructure spending at a time when the deficit's widening? The key question.
A question we'll be asking through the morning right here on Bloomberg Radio. Looking forward to catching up with, a little bit later, Neil Dutter of Renaissance Macro. Jeff Rosenberg of BlackRock will be joining us as well. In your equity market futures positive, this is Bloomberg.
Why?
Introducing the new single, Impossible. From Central American rock and blues trio, Steady Rolling. Their epic story of love and loss continues. Download and stream the single, Impossible, from the band Steady Rolling, wherever good music lives.
The trampoline that makes Dad feel like a kid again. The projector that turns film night into outdoor cinema night. The hot tub that transforms your garden into a spa retreat. With a choice of ways to pay, you can make the most of family time. You can say yes when it matters most at very.co.uk. Goods and services provided by Shop Direct Home Shopping Limited. Credit provided. Subject to status by Shop Direct Finance Company Limited. 18+.
A half-price dream holiday. Wouldn't want to miss that. A takeaway for free. Wouldn't want to miss that. And 30 gigs data for just £10 a month on Smarty Mobile. You definitely don't want to miss that. Our Smarty SIM comes packed with 30 gigs of data and unlimited calls and texts for just £10 a month on a 1-month plan. That's why Smarty won Best Value SIM-only network in the U-Switch Mobile Awards 2020. Don't miss out. Search Smarty Mobile. Smarty. Simple, honest mobile. Smarty.co.uk.
Picture in your mind a stylish Audi with striking LED headlights, sporty alloy wheels, and some of our most advanced features, including a 10-inch digital cockpit and smart assistant systems like lane departure warning. Picture what that Audi looks like. Now think smaller. The Audi A1. It's not a small car, it's a small Audi. Visit audi.co.uk. Audi. Vorsprung durch Technik.
For more than 20 years, Asda supported our communities. We've raised over £23 million for Fair Share and the Trussell Trust. And recently, we've donated supplies to frontline NHS workers and carers. We've always been proud to serve those around us. Visit asda.com/creating change for better. Asda, we're all in this together.
While most of us are looking out for each other at this time, sadly, fraudsters are trying to take advantage of the situation. Here's Chris Ainsley from Santander with advice for keeping your money safe.
Please be wary of text messages containing links. They may appear to be from legitimate senders like the government, a bank or a delivery company, but never enter your online banking information or personal details after clicking on a link.
For more advice on keeping your money safe, visit santander.co.uk.
Where will 2020 take you? Somewhere where people care. About each other. About our planet. About creating a better world for everyone. And becoming the best versions of yourselves. Join a community of like-minded individuals at the University of Winchester. Make sure to accept your offer by the UCAS deadline and visit our website to find out more. See the bigger picture. Be the difference. Go to winchester.ac.uk.
Typical Danny. Imagine trying to unwind at a spa weekend and you wind up getting your mud pack all over your fave personalised dressing gown. But no worries, just one wash and my clothes will smell perf with Surf. Surf gives you long-lasting fragrance with natural essential oils. Find your fragrance in Surf's laundry range.
Talk about the losers in a trade war.
You benefit if you're just further away from China.
So that you can too.
What are the ramifications if she crumbles or doesn't crumble?
Bloomberg Radio, the Bloomberg Business, Radio.com, and iHeartRadio apps, and BloombergRadio.com. Bloomberg, the world is listening. From the financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. This is Bloomberg Surveillance Economics.
A lot of us are still in a bit of a guessing game, trying to determine how severe the downturn will be. The only thing that can bring an end to the crisis is containing the disease.
Finance.
We are the one country where people depend on employment for health insurance in the middle of a health crisis.
Investment.
Real yield is a scarce asset these days. It's just unknowable, of course, where things are going.
Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz on Bloomberg Radio.
Good morning, everyone. John Farrell, Lisa Abramowitz, and Tom Keene. This most historic day for the American economy. The data goes back to 1947. The nation goes back well over 200 years, and we have simply never seen this. Not in the influenza out of World War I. This is a pandemic-affected labor economy, and the government will report here in 29 minutes on this horrific job economy. We've got wonderful guests lined up to give you perspective, particularly forward into the summer months, and of course the market analysis as well. John, I want to dovetail in here the historic moment of this job economy with what you and I observed yesterday afternoon in the interest rate market. And dare I say that rates are simply pricing in further economic pain.
Further pain and lower rates, and maybe even negative rates in the future. I'm not sure if that's a technical quirk, because I've heard nobody on the Federal Reserve suggest or endorse negative interest rates in the future. I think what is interesting about this moment compared to the crisis of 08, 09 and coming out of that is how quickly markets have got the joke. Rates aren't going up anytime soon. There was a belief coming out of the financial crisis in 08, 09 that at some point in the next 12, 18 months, rates would start to go up again. And guess what? They didn't. We didn't increase interest rates until 2015. This time around, Tom, there is a deeper belief that it's low for longer. I hear very few people pushing back against that. How long we stay this low for, I have no idea, but I know there's a lot of people out there modelling at least a decade.
And, of course, Bank of England going the other way yesterday. Callum Pickering quoted all over the United Kingdom media in his shock at the Bank of England saying minus 14% and then up plus 15% in economic growth. Lisa, within all that we've talked about this morning, and John mentioned earlier, the breadth of what we will see in 28 some minutes is, if you take out the obvious industries that have been crushed, airlines, bartenders, waitresses, restaurants, and that, there's a real mystery here about the rest of the American labor economy, isn't there?
There's sort of a mystery, except that early ADP data shows that it is broad-based. I have to say, Carl Riccadonna sending a follow-up, and I will just say, he wrote in a report today, imagine all the job losses in every recession dating back to the second administration of Dwight Eisenhower, concentrated into a single month. That is the magnitude of what forecasters anticipate in the April employment report. I am blown away by this.
It was really important that he did this, because I asked the question, and this is what Carl's responding to. People really struggle to internalize numbers this large. We really struggle to conceptualize large numbers. That's just true of human beings throughout the whole of history. And I think it's important to break things down that way so people realize this is not just any other number.
Yeah, and to that point, he also said this will rewind employment levels to 1999. Not a single job created since then.
It's appropriate to mention General Eisenhower and this victory in Europe's 75th anniversary. And with that, dovetailed into the second term of Ike is the first term of Ike, where this nation experienced outright deflation. Then no one talked of negative rates. We've been talking a lot about the labor economy, and we'll do that through the next 27 minutes. But we're thrilled now to bring you Ira Jersey with his wonderful fixed income perspective as well. To John's point, Ira, let me just go to the money question, and then there's a lot more to talk about. Is this a nation prepared for negative interest rates?
So it's really not. So I think a lot of the reason why some of the markets are pricing for negative rates later this year. I mean, now we're pricing actually for the Fed, some chance of the Fed to cut in December of this year to negative rates is technical. So basically, when you're a risk manager at an insurance company or a bank or somewhere else, and you say, okay, what are the risks in my in my portfolio? One of those risks is that the Federal Reserve cuts to negative 25 or negative 50 basis points. And if they were to do that, that has a significant both earnings as well as internal operation issue for a lot of these institutions. So people hit F9 on a spreadsheet, and then that updates and says, oh, you have to hedge for 50 basis points lower risk. And so I think one of the things that's been happening is there's been a lot of risk managers basically forcing rates to below zero. I think that'll ultimately come back the other way, and we'll probably price for zero rates, but we're not going to price for negative for very long.
The path for interest rates going forward. Ira, can you just paint a picture for our audience, the difference between now versus coming out of 2009, what the expected path of interest rates looked like then versus now?
Well, so yeah, coming into 2009, everyone thought, oh, the Fed's going to hike at some point in the next 18 months or 2 years, and then that kept on rolling forward and forward and forward until about 2015, and then we started to actually price for hikes that were realized. I think at this point, at this point, we could just look at where the Treasury yield curve is as a perfect example. No one's expecting the Federal Reserve to really hike for at least 3 or 4 years at this point. And even then, if within 5 years, you're only expecting them to hike once. So basically, it's a very slow, much slower expectations. And I think this current yield curve is informed by what happened in 2009. Like, people just know that when you have an economic shock such as this, the Federal Reserve is going to be more cautious than not and keep interest rates at these kind of levels for an extended period of time. I think it's more likely than the Fed cuts to zero that they talk about some kind of yield curve control, which means that they just do what the Japanese have been doing and say, we're going to continue, and what, quite frankly, what the Fed did back in the 1940s and 50s is, we're going to buy every single 10-year note if the 10-year note goes above 75 basis points. We're going to keep it at 75 basis points and not any higher than that. That's much more likely, I think, than negative interest rates.
So this is what I'm struggling with. The FOMC has said that they're not going to do negative interest rates. Pretty much people are taking them on their word, talking about yield curve control. And yet here we have people pricing in that very possibility. We have Priya Misra of TD Securities coming out with a report yesterday saying, fade the negative futures, saying that they don't think it's justified by fundamentals or any kind of signaling from the Federal Reserve. Do you think this is some sort of short squeeze or technical feature that we saw in oil markets coming to Fed funds futures?
Yeah, it's a little bit different than what happened in the oil market, but it is something similar, akin to that. So like I said, my read of it is that it's more risk managers forcing some people to buy, and then people don't want to sell in front of it. So I think over time it'll end up fading, and you'll wind up with Fed funds futures, for example, trading at par, so expecting zero interest rates, but not much more. It's very possible even that the Federal Reserve could actually really create a long squeeze in a way, because it's possible with the Fed funds effective rate trading at the lower end of the band of the policy band of 0 to 25 basis points, that the Fed could actually increase interest paid on excess reserves, which is this interest rate that they pay on the now many trillions of dollars and rising of reserves that banks hold. They might raise that 2 to 5 basis points, and if they do that, a lot of these people who are long Fed funds futures at, say, par, are going to wind up feeling a lot of pain.
just thinking about this curve just a little bit more, Ira, I'd love your thoughts on this. If we are projecting low rates for longer, let's think about that a little bit more. Right now, the 2-year yield is basically pricing that in at 12 basis points on a 2-year yield. But if we're really thinking about the last decade as the model for this, coming out of the last financial crisis, why is 2s, 10s as steep as it is right now?
Well, because so I think there's a couple of reasons for that. One is that when the Treasury Department is issuing, trillions of dollars of debt, and especially with trillions of dollars of that coming in the long end, so a new 20-year bond is going to debut on the 20th of May. More 10s, more 30s. That is going to wind up needing to be digested first, unless the Federal Reserve says that they're going to come in and do yield curve control. So I think that there's a natural buffer there where people don't want to do it, and there is some optimism, I think, as well. And this is something else informed by, say, the 2009 crisis. Is at some point the Fed will hike, and interest rates. Fed funds rate might be 5 years from now at 1%. So if it is, you have to take kind of the average of now to 10 years from now, where you think Fed funds is going to be.
You're just joining us, Ira Jersey, running all of our fixed income shop for Bloomberg Intelligence as well, and also hugely committed to American soccer. He knows the difference between the Tots and Arsenal.
He does.
Ira, I want you to talk. He does. I want you to talk, Ira, to the people on the soccer field. I want you to talk to the people on the soccer. I'm ignoring John. Thank you. I want you to talk to the people on the soccer field who wouldn't know R-starred from all this mumbo jumbo we're talking about. When does the public get a fair interest rate?
Well, it depends on what you consider fair. If fair is real yields at 0, you're probably looking at somewhere for 10-year yield, somewhere 5 or 6 years from now would be very likely, or I should say the earliest that you'll likely see that, and that's just because even if we have this quote unquote V-shaped recovery, you're still not going to have inflation or economic growth that is on a sustained basis anywhere near where it was, say, in the last couple of years. So a fair interest rate, meaning that savers actually receive, a real yield of 0 is, years away at this point.
You're killing me. John, round it up. Ira Jersey says we're going out 20 years from 2007 to normal.
Unreal. Just the whole thing has been totally unreal. The experience through the last decade and through the next one as well, potentially too. Ira, great to catch up with you on an important day. Ira Jersey there of Bloomberg Intelligence. Here are your news, your headlines worldwide. Here's Michael Barr.
John, Lisa, Tom, thank you very much. The White House is explaining why it rejected the CDC 17-page recommendation for reopening the country during the pandemic. Bloomberg's Martin DeCaro reports.
White House Coronavirus Response Coordinator Dr. Deborah Birx says the CDC guidelines needed to be edited. They were too strict for certain parts of the country and therefore not helpful for nationwide guidance.
It was more about simplification to really make sure that both the American people as well as public health officials understand the guidelines.
Dr. Birx says the public will see the revisions.
No one has stopped those guidelines. We're still in editing. I just got my edits back from the CDC.
Some administration officials were reportedly concerned the initial guidelines infringed on religious rights by placing controls on attendance at church services. In Washington, Martin DeCaro, Bloomberg Radio.
A World Health Organization scientist said COVID-19 comes from bats and can spread among cats amid an international debate about the virus's origin. Peter Benemberich, an WHO expert in animal diseases that jump to humans, said today the virus is food-related but not food-borne. Barrick says it's still unclear what animal may have transmitted the disease to humans. Children with COVID-19 threaten recovery from the pandemic, sparking increased scrutiny from their cases from scientists and policymakers seeking clues about how the new coronavirus spreads. While infections of those under 18 compose a small portion of the worldwide total, the number is in the thousands, and in recent days have become the subject of a National Institutes of Health study. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg. John.
Michael Barr, sir, thank you. Michael Barr there with your news, your headlines worldwide. We are 17 minutes away from the payrolls report in the United States of America. The median estimate as follows, negative 22 million. The unemployment rate expected to decline from 4.4% to 16%. Wages will be an interesting quirk. We'll talk about that a little bit later when the number comes out. It is expected to be dreadful all round. An ugly payrolls report for a really difficult time for millions of Americans and millions of people around the world as well. Our coverage continues from New York. This is Bloomberg Surveillance Live on Bloomberg Radio.
NJIT, New Jersey Institute of Technology, makes innovation happen. The university helped biomedical engineering professor Tara Alvarez launch a startup that may revolutionize vision therapy.
Our startup through NJIT is called Oculomotor Technology. We create virtual reality vision therapy in a head-mounted display. So it's gaming, and basically we're sugarcoating the therapy so that children and young adolescents don't even realize they're doing therapy. To accomplish this, we need biomedical engineers, which are here on NJIT campus, computer scientists, artists, people that are into story development, and then we're collaborating with a lot of the large pediatric medical centers. This idea of a startup culture is extremely important to not just NJIT and the National Science Foundation, but also to the U.S. as a societal whole.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
Not completing high school is more of a social thing than it was an academic thing. I came out in the 11th grade. Nobody was embracing you. The kids were cruel. It was very difficult to be gay. Even though all these years have passed, I still had that longing to have my diploma. The hard part was determining that I was going to do it, but I definitely didn't do it alone.
At age 30, with the help of her mentor, Carissa finished her high school diploma.
I have a mentor, Maria. She convinced me to continue my education and to finish what I started to get my diploma. Just never judges. She's a true role model. If you're even considering getting your high school diploma, go get it. You can do it.
No one gets a diploma alone. If you're thinking of finishing your high school diploma, you have help. Find free adult education classes near you at finishyourdiploma.org. That's finishyourdiploma.org. Brought to you by the Dollar General Literacy Foundation and the Ad Council.
This is a message from the government about the emergency measures to support the economy during the period of disruption caused by the coronavirus. To help you, your business, and your workers affected, you can apply for cash grants, business rate holidays, statutory sick pay relief packages, as well as the coronavirus job retention and self-employment income support schemes. For information, go to gov.uk/business-support now.
Did you know that players of People's Postcode Lottery have raised over £500 million for charities and good causes? They've also won £63 million in prizes so far this year, and it could be your postcode next. Visit postcodelottery.co.uk/radio before midnight on the 21st of May to play in the June draws. PPL manage lotteries on behalf of good causes. 16+. Conditions apply. Play responsibly.
Somebody has a stroke every 5 minutes in the UK. With time, though, courage, and the right support, lives can be rebuilt. Mine was. But with this current crisis, I can't imagine how much harder it must be for the stroke survivor and their family, more isolated and alone than ever. The Stroke Association is working tirelessly to support the NHS and develop new ways to rebuild lives. To find out more or to donate, search Stroke Association now.
And breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
And I'm Karen Moscow. We are just 13 minutes away from the April jobs report. Ahead of that, futures are higher, with S&P futures up 25 points, Dow futures up 199, and NASDAQ futures up 76. The DAX in Germany is up 1%. The 10-year Treasury up 3/32, the yield 0.62%, and the yield on the 2-year 0.12%. NYMEX crude oil up 0.9% or 22 cents at $23.77 a barrel. COMEX gold is up 0.1%, up $2.40 at $17.2820 an ounce. The euro 1.0843 against the dollar. British pound 1.2386, and the yen at 106.36. That's a Bloomberg Business Flash. Tom, John, and Lisa.
Karen, thank you. Thank you very much. The jobs number 12 minutes away. We're familiar with these massive numbers now. We're familiar with the size. We need some more detail on the scope, the breadth of the job losses, and our attention will quickly turn to how quickly this labour market can heal, Tom. And I think that's the number one question for a lot of people right now.
It is easy, John, to speak to people with a tilt to gloom. We did that yesterday. Nora Rubini was just lights out yesterday, folks, with his concerns listed out carefully about this greater global economy. How about someone who's a glass half full? That would be Mr. Dutta, Neil Dutta of Renaissance Macro. He sends me piercing short emails when the gloom crew shows up, and today we will glean some optimism from Mr. Dutta. Boy, it's a tough task today, Neil Dutta. How can you be optimistic out of this horrific report?
Well, I mean, look, so Tom, was this not known? I mean, I guess the thing is why are we losing jobs? Why are jobs being shed? Not only in the This isn't unique to the United States. You guys reported this morning that Canada is set to lose 2 million jobs over the month, right? So that's about double what they did last month. Okay? Why is this happening? This is happening because we need to slow the spread of the coronavirus, or at least we were trying to do that in April. So the math that matters isn't that 22 million people are losing their jobs in April. It's that 2 million people otherwise are not going to die. Okay? So basically I think the way to think about it is for every 11 jobs that are being lost, one life is saved. Okay? So I think that's what people are missing. This is the result of a deliberate policy choice. So what we really need to focus on as market analysts isn't necessarily the amount of job loss. It's the extent to which the government is able to plug the massive income hole that is being left in the wake of this job loss. Right?
Neil, this is the key issue, and this is the reason why people are saying that equities are rallying. It's because the Federal Reserve has pumped so much liquidity into the system, and the federal government in the United States and elsewhere have shown willingness to continue to print money in response to this. Yet that's also not factoring in a prolonged episode here with a resurgence in viruses. So do you think that perhaps markets are pricing in the most optimistic case scenario right now?
No, I don't. Because what you just said there is something that everybody already knows. How many people have gone on, out there talking about the potential for a double dip in the fall because of a second spread of the virus? That's in the market. Tell me something I don't know. So that's in the market. What you just said is in the market already. But if you look at the economic statistics that have come out, we do have massive job loss. But what we also know is that 3 weeks before the lockdowns officially ended, the first week of May, motor gasoline demand is starting to pick up. We know that travel screenings in our nation's airports, that bottomed sometime in the middle of April. Redfin is reporting that their home buying demand is basically back to where it was in January and February. We've seen mortgage purchase applications rise for the last 3 weeks. So you have to ask yourself, is the economy down because of a financial constraint or a physical constraint? I think it's primarily a physical constraint. The reason people aren't spending money, sure, there are some people that aren't spending money because they have none, but primarily it's because they can't. Things are closed. So, I think, to me, there are two kinds of people in this world when the markets are going up. There are those people that argue it should go down when it's going up. And there are other people that try to figure out why it's going up in the first place. I prefer the latter.
Well, Neil, for me, this is not about markets. I want to talk about the economy with you. And I think the points you've made are points well made. They're points that have been made on this program multiple times over the last couple of months. This was a policy choice to save lives. I think where there's a debate and where we should have a debate is what this economy looks like when we reopen. And I think it's easy to say it's artificial to a degree, because it is artificial to a degree. But it's usually a point made by people that still have jobs. And I'm trying to work out that when we reopen, how quickly will these jobs actually come back? How quickly will they come back?
Well, so I think then it becomes it's a conversation about what industries, right? I mean, I think certain jobs will come back more rapidly than others. As an example, I think, in the goods producing sector, for example, I think those jobs will come back more quickly than than jobs in the service providing one, and that makes the recovery process a bit more challenging because obviously the U.S. is a very service-orientated economy. But things like construction, manufacturing, those should come back more quickly than restaurant jobs, as an example. Certainly the jobs that are being lost in like the professional and business services categories, the administrative categories, I think those jobs will come back. The St. Louis Fed has done very, very interesting work on looking at the extent to the percentage of jobs in the U.S. economy that require close physical contact. Those jobs like barbers, hair, nail salons, things like that. I mean, those will take more time. I mean, and obviously, barbershops aren't traded on the S&P 500, right, guys? I mean, so that becomes a more challenging issue. But I think what you'll see is, Milton Friedman's plucking model still has some weight. In other words, the depth of the decline is and is still an important, provides some utility in telling you about the speed of the improvement off the low. So I think the initial part of this is going to feel like a rapid recovery. You'll see strong sequential growth rates. I think the issue is next year. I think we start to maybe see some of that momentum slow as a lot of these issues, things like, the University of Chicago put something interesting out yesterday talking about how, maybe like a fifth of the paid employment loss is a function of business exits, right? Business formation is an important driver of employment activity. And that's a process. So to the extent that businesses are slow to come back, that means jobs are going to be slow to come back. But I do think that the initial rebound is going to be, the sequential growth rate numbers will look relatively quick. Now, whether that means we'll get back to where we were, in terms of level or relative potential, I think that's a different story. But things won't be good, but they certainly will get better.
Neil, great to catch up with you. You're going to stick with us and get your response immediately after the payrolls report. Neil Dudder there of Renaissance Macro, the head of economics, making the point that the market right now, Tom, focused on sequential improvement that's about to come around the corner in the next couple of months.
Just remarkably stark to hear Neil Dudder there versus Dr. Glassman at J.P. Morgan with his work with Robert Gordon at Northwestern. It's just amazing, John, the differences in perspective you can get over the same historic event.
Well, that's the market, isn't it? There's always a debate. Yes. Equity futures up 25. We're positive 0.9% of the S&P 500. From New York, the payrolls report is up next. This is Bloomberg.
Asset managers who seize change to launch new strategies, add distribution channels, or exploit new technology to re-engineer the investor experience are often rewarded. However, in an industry paralyzed with complexity, few act with agility or decisively. Few run their business strategically. Yet, the most competitive managers in the market know, with the right partner and a flexible operating platform, you can. Go boldly toward change with SEI Investment Manager Services.
I'm Steve Meyer, president of SEI's Investment Manager Services. At SEI, we understand the emerging forces that will define success for asset managers and what firms will need to compete tomorrow. That's why we continually optimize SEI's global operating platform. If your business requires greater agility, our advanced technology, integrated best-in-class systems, and multi-asset expertise can be your catalyst for business transformation.
With SEI Investment Manager Services, you lead the charge in a competitive marketplace. Learn more at SEIC.com/seize change.
Business is constantly evolving. Is your financial printer evolving to keep ahead of the curve? At Command Financial, we are redefining financial printing by providing industry-leading expertise, leveraging technology, and honing processes and best practices. Every day, Command helps SEC registrants, as well as members of their working groups, including securities attorneys and investment bankers, prepare, file, and disseminate regulatory and disclosure documents, such as registration statements, M&A documents, and mutual fund prospectuses and reports. Command provides a full range of services to help you effectively complete your deal, meet your disclosure requirements, and achieve your shareholder communications objectives. Visit our website at commandfinancial.com and learn how we're evolving, not only with the times, but also with your business requirements. Command Financial, redefining financial printing.
This is a Bloomberg Money Minute. The trampoline that makes Dad feel like a kid again. The projector that turns film night into outdoor cinema night. The hot tub that transforms your garden into a spa retreat. With a choice of ways to pay, you can make the most of family time. You can say yes when it matters most at very.co.uk. Goods and services provided by Shop Direct Home Shopping Limited. Credit provided. Subject to status by Shop Direct Finance Company Limited. 18+.
Did you know that players of People's Postcode Lottery have raised over £500 million for charities and good causes? They've also won £63 million in prizes so far this year, and it could be your postcode next. Visit postcodelottery.co.uk/radio before midnight on the 21st of May to play in the June draws. PPL manage lotteries on behalf of good causes. 16+. Conditions apply. Play responsibly.